Okay, I think we're there. So welcome everyone to this second session. We had opportunity a week ago to talk with or to listen to Dave McMullen with giving us some ideas about finding trades and some of the techniques that he uses. And we went for 2 hours on that session. It was really great. I know there were a bunch of questions that we didn't quite get to. And so Dave actually suggested that we come online again and go through a few other things, answer some questions, and just make sure everyone has their question answered. So I think the way we'll run this is if you have a question you want answered, you can raise your hand. That's a thing you can do in Zoom. And I can open your mic, and that way you can actually ask the question with your voice. If you don't have the ability to do that, then what we could do is you could just type it into the chat and I'll monitor the chat and relay the questions. So that's how we'll handle questions. And then if there are no immediate questions, then we do have a couple of things that we can get to. I'd like to welcome Dave McMullen is online. Hi, Dave.
Hi there. How's everybody doing?
I think they're doing okay. I can hear you.
Okay, good.
And they can hear you.
Okay.
And if you have a look at the chats, you'll see some responses to that.
Okay, good.
Okay. So Dave, I'd like to hand it over to you and just, but you can always hand it back over to me at any time, and we'll just sort of play it by ear, see how it goes.
Okay, what I'm going to do is I'll share my screen, which will give you, many of you have already tried to contact me that have been around for a long time. I'm glad to see a lot of the names. I've got a real problem with frog in the throat this morning. I'm going to share my screen. And this will give you my contact information. Can you see that okay, Chris?
No, that's not come through yet.
How about now?
I'm not seeing it. If anyone else can see it, though, let us know.
There you
go. Here we go. There we go. Yep.
You got it?
I got it. Yeah.
Okay.
We got it.
Now I'll have to figure out in a minute how to get that off the screen so we can proceed. I have an honor and a privilege to have monitoring us today. He's on another call, but he's smartest man I know when it comes to trading, and that's Dr. Jeff Scott. And I haven't seen Dr. Scott for quite a number of years, but he's a very excellent trader and one of the nicest people you ever want to meet. So if you ever have a chance to pick his brain at a convention or a meeting or a seminar, look for Dr. Jeffrey Scott. Like I said, he's a smart man.
Yep.
I'm going to try and get this thing off the screen now and get to something else. Now that I got this up here, I can't get it off, Chris. There we go. Now I can close it down.
I think the key is you got to press the escape button.
Yeah, I did that.
Yeah.
But it wasn't escaping.
Okay.
So let's start off with questions. Jump in here because swallow that frog. Yeah, I will. Raining heavily in British Columbia. Well, It's sunshiny here in Texas, but I'm going to hang out here for a little while, and that'll change like it does every day. We'll get a monsoon somewhere around 3:30 or 4 o'clock. We had a question from Brian. And Brian, are you on today? There was several questions wrapped into his question. But a lot of it had to do with me going too fast and covering too much information in such a short period of time. And this program is a very terrific program, very powerful. And I use a lot of tools, as you can see from my my tray down here at the bottom. If I've shared my screen, you guys should be able to see it all. But you know, certainly Thinkorswim is an important part of my trading. TradeStation is. I have an options program and several others. I have many different programs, and we'll get to some of those today. But Brian, what your question is, what's the best way to determine a stock's direction? Well, how about a curveball? How about a rune? On a rune indicator is a strength indicator of trend, and you can find that in many charting programs, but I don't use that much. The best way to determine whether a stock's going up, down, or sideways is to put a chart up. And so let's do that. And this is the Brazil ETF. And what direction is this moving average going here? It's going down. And as you see, these two moving averages going down, you can see the price is going down too. So that's a great way to determine what direction it's going. So we can put any one of a number of different moving averages on. The ones that I tend to keep at my fingertips are the 8 and 20 moving average, the 50 and the 200. And that's what you see on this screen here. But you can see that those are the best way to determine a direction. This is the best way to get eaten up. This is called chop. Does everybody see the chart of SPGI? I'm hoping so, because
we see that, Dave. Yeah.
Okay, I get no feedback like I get with an audience. So this one's going sideways. And what do you do when something goes sideways? You go sideways. Stand aside. Okay, so what I try and do to improve my I'm really having trouble with this frog. What I try and do to improve my odds of winning trades is to look at statistical probability. And statistical probability over the last 10 years on this stock for the next 2 months is 4 out of 5 years it's up, and it's up 4%. Okay, so your statistical probability there is pretty high that over the next 2 months it's going to go up. If you look at VIR, that's only gone up for 2 years. So what I try and do is find stocks by first determining the market direction, and I do that with SPY. I mean, there's a lot of different ways to see. There you go. There's a lot of different ways to look at the market or time the market or figure out what direction the market's going. You can use SPY because it's the S&P 500, the 500 best stocks in the market. If you wanted to do the Russell, you'd look at IWM. Let me see if that one's in here. That gives you the 2,000 stocks, and those are the smaller and mid-cap stocks. And then, of course, you can also look at the Dow, and this is up to date. Oops. Okay, that's NVIDIA, and what it's looking for is, nope, there it is. I need to go back one. Let's find, there's the diamonds. Okay, those are the 3 major ones. Now you can look at a gazillion different indexes on lots of different platforms, including your broker's platform, and some of them have timing indicators and things like that. But you start with market direction. Right now, today, market's up and down. It started out up, it went down, and now it's heading back up again. It's down 646 points right now. So yesterday, it was up, and today it's going to be down. So your bias should be what the market is, because most of the time the stocks that you're going to trade are going to trade the emotions of the traders is going to be with what the market is doing. Yesterday, Amazon was up 30 points. I'm sorry. Well, it's a really bad case of frog today. And I don't know why. So that's how I determine the direction of a stock, is I will look at the current status of the market by looking at the indexes, and then I'll take a look at a stock. And if we wanted to look at Apple, for instance, it's not listed right now in this group of stocks. So let's get something else that you might be familiar with. There's Facebook. Facebook has been in a downtrend for some time. I don't expect it to resume an uptrend, particularly when the market is dropping. So if you were going to invest in Facebook, be very prudent about how you spend your money and whether you would want to be long or short. Right now, the statistical probabilities over the next 2 months is that it will go up 6%, 8 out of 9 years. So that's a pretty strong statistical probability that at some point in the next 2 months, it's going to issue a buy signal. And a buy signal for me is going to be generally when the 8 crosses the 20, and particularly if the 50 moving average, 50-day moving average is heading up also. And this is why I would not be looking to be long Facebook right now. When the 50 moving average is heading up, and that's the magenta line, and the 200-day moving average is moving up, then you can be assured that generally speaking, you're going to have your ABC up and down continually, and it will trade somewhere at or near the 20-day moving average. And if it gets too far away from the 20-day moving average, it will come back. And then you can see it breached the 20-day moving average here, and then it popped back up again, and it got too far away and it came back down. And that's the way the markets trade until, in this particular case, Mr. Zuckerberg finds himself in trouble and feels it necessary to change the name of his company to Meta. And you can see as soon as the 8 crossed the 20, if you'd have taken a short there, that was 373 points. It dropped 50 points down to the 200-day moving average, and the 50 has turned down. And until that 50-day moving average recovers and turns up, and the 20-day moving average, and this is a good consolidation in here. The 20-day has shown some signs of life, and it may turn around, but there's other ways to find a lot of trades. Okay. Brian, I hope I've answered your questions. I can't see the chat box right at the moment for some reason.
Dave, so then Brian did ask in the chat box whether you are using simple or exponential moving averages.
Okay. I generally use the 8 exponential over the 20 simple, and then the 50 and the 200 are simple. Okay, I just I use the 8 as an exponential because I want it to move a little quicker.
Okay. All right. Now some other questions have come in. So Ralph was asking. Ralph suggested that you created your own template from the getting started template and added some existing ones, expected move, etc. Actually, what happened was that I created that template for Dave after talking to Dave. But basically, it was pretty much just a copy of the seasonality template on the back end, which I added into, from columns W onwards. And then I just put into the front side of that some of the things that Dave was looking for. But it should be, you should know anyone can create a template. Once you get the hang of it, it's not that hard. But and there are videos on YouTube about how to create a template. Also, we should do some more online sessions about creating templates too, because people have their own indicators that they like to use, and it's very useful to put them into a template. So we'll get to that.
This is the template as he created for me, and basically this is the data view data and the close price, and then it gives you the values of the different moving averages, and it will tell you if it's above and if it's accelerating or decelerating. And then this is nothing more than the seasonality monthly. Let me give you this here. This is the seasonality monthly. And this is what we traded for years and years and years. And it didn't matter whether, let me just squeeze this over for a minute. My mouse is real touchy today. Everything about me is touchy today. Okay, so here's January to December. Okay, and I haven't sorted any of the columns, but this will tell you generally over the last 10-year period of time what the best time of year the market will move or a stock will move and what percentage it will move average over the period of time. So if you wanted to set up trades for now through January, you'd want to look at the December column, and you can see December's pretty tough on Facebook. We still have it highlighted here. 4 out of 9 years it goes down, or 5 out of 9 years it goes down, and then into January 6 out of 9 years it goes up, but it doesn't go up very much in January. It goes up 8%. So what I try and do is I try and look for possibilities, because this is where you can spend an awful lot of time with sorts and scans and looking for trading opportunities. But I'll generally start here and then go to I'll start here. I'll go to 2 months, because I want to know what's going to happen, not just in 2 weeks or 6 weeks. I want to know what's going to happen over the next 2 months, so I can place a weekly options bet, or a monthly, or perhaps even 2 months. And in this case, you can see how this is sorted. The first column I sorted it by is 7 to 10 years. Okay, so the look back period on all the stocks in the weekly CBOE weekly stocks, there's 70% chance or better that something's going to go up. Okay, now I can also sort the percentage from greatest to least. So here is the stocks that have the 70, 80, or 90% chance of going up. So they have a statistical probability of going up over the course of the next 2 months. And this is what the average trading amount is. Okay, then I'll take this number. Sava, my granddaughter, actually traded in her portfolio for the DECA contest, and she did quite well. I'll actually show you the chart on that one, because she started in September. I think it was September. I think she took it here. Yeah, I think her interpretation was she took it here thinking it was a double bottom, because we talked about it. And she learned at that point you know, that when the 50 days going down like this, you got to wait to take your trade. And so she got burned on Sava in the early goings, but then she picked it up and she made a few dollars on it, because they could only trade stocks. They couldn't trade options. And she recovered. I think her entry was like right in here at the end of September, 1st of October, because we talked about seasonality for the market and that she wanted to wait till October, but the contest had already started, and she was anxious, as 17-year-olds can be. So anyway, she did make a nice little bunch here, and when it hit the 8 again here, she got out. So she recovered from here when she once she got back in. She recovered her losses and exited, and she did a great job of exiting here. But she found out that she did not want to trade those mime stocks. What were they? They were trading Game Changer, and I think some of the kids had Dogecoin and a few others. So she learned real quick. So what I try and do is I try and match things up with what I know. And that's an old Peter Lynch teaching. If you haven't read Peter Lynch, go find his old book and read Peter Lynch. There's a lot of good learning to be done. How come that's not sticking? Okay, there's Netflix. Now I can highlight the line. Okay, now Netflix over the next 2 months, it's 9 out of 10 times it'll be up 31%. But it looks like to me that there's not a lot going on in the front month. Okay, which would be maybe December, but perhaps in January. And if I want to check that, I can look over here just by going to seasonality monthly. And as soon as I highlight it, Netflix pops up too. And you can see that December is only 2%. What is January? January is 29%. Okay. So do I want to position myself right now in Netflix? Probably not. But if I do, we talked about a back ratio spread a little bit the other day, and we'll talk about that again today. But you could actually put on a back ratio spread, but you're going to spend some money now that you wouldn't necessarily need to spend, or buying power, that is. You could actually wait till the middle of December. So if you took your opportunity worksheet and I'll send the template over to Chris and let him forward it on to you, because the opportunity worksheet doesn't do anything but give you a place to write down reminders for yourself. Everybody can do things on the computer. This happens to be an Excel worksheet. But for me, it works better to write it down. And all you do is write down the date that you discovered it, the symbol, whether you want to be long or short, and what the window of opportunity is. And in this particular case, the window of opportunity would be starting December 1st. It's on your watch list. And when you get to, and we'll just do it on this one, when you get to this is a triple bottom over here on this chart. I'm going to shrink this up so I can get some more real estate for the chart. My mouse is not very cooperative today. And of course, the gardener has to be here now too. Can you hear him in the background?
No.
What direction is the 50 going? It's starting up. What direction is the 200 going? It's starting up. What direction is the 20 going? It turned up. And where did the 8 cross the 20? Right here. And that would have put your buy at 520. And where did it top out? 690. That's 170 points. If you bought a 50 delta option here and all you did, the 50 delta is going to give you half the move until it gets in the money a lot. You're just figure 50%. So you got 170 points total, and at a 50 delta, you get half. That's 85 points times one contract is $8,500. Okay. So that's the kind of thing that you want to look for coming up as soon as this down move is finished in a couple, 3 weeks. Okay. So that's what I would do. Then next, I always monitor the volatility. The historical volatility on Netflix is 28%. Volatility is up on implied volatility for the next 30 days. Okay. Its current rank is 40 over the last year is 47. Now I look at the rank for 30 days, 100, which means it's moving and shaking. Okay. So what is the expected move? What are the options traders expecting the Netflix to move in the next 30 days? The options traders, in most cases, are pretty smart guys, and they're looking for 11%. 11% of a $665 stock will put it up to $739. Okay. Well, that's $73.55. And here's the probability cone to show you where it has the possibility to go. Now you've already got an 80% chance that it's going to move up. Okay. And now you're looking at an 80% chance you're going to get that 70 points and a 20% chance it's going to go down. But there's still plenty of people betting that it's going to go down. Okay. They're betting 11% up and 10% down. That's the expected move that's being bet on at the options Chicago Board Options Exchange. Sorry, I'm a little brain dead for some reason. And this is what that expected move is going to be for 60 days. That's the cone for 60 days. Mm-hmm. Okay. And you can see that the volatility has come down and it's come down, and now it's starting to rise. And a lot of that has to do with the market moves. And you can see, the short term and the midterm and the long term as seen here in the expected move. Okay. So that's where I use expected move together with the moving average cross and seasonality. So I'm loading the boat in my favor by choosing the stocks that have a track record of traveling with the market when the market turns up. Okay. Mm-hmm. Next question.
Yeah. So I think that answers Imran's question on his question actually was what are the actionable signals on the Dave McMullen template?
Okay.
So is there any more to say on that?
Actionable signals will be, I'll go back to that template here in a second, but that's an actionable signal right there. Bada bing, bada boom. Okay. That's the 8 and 20. Now you can't see it so well on that chart, but here is one that you can see it a little bit better on. Let me see if I can. Got one already here. Yeah, here we go. Haha. I'll bring this one into the mix. Okay. This is the chart that I watch every day. Okay. So here's what's actionable. Right here is, and I'll take this and I'll put it right there. There is a crossover of the 8 and the 20. And when I get the confirmation right there, that's when I'll make my move. That's when I'll make my change. And you can see there's a lot of things going on in this chart. First of all, I have an 8 moving average crossing over the 20, which just happens to be the mid band of the Bollinger Bands. And the Bollinger Bands have crossed below the, and I need to redefine this. This particular Keltner channel is 1.5 average true range. Okay, I think I quoted the other day it was 2, but if I was to go here and look at how they're actually set up, the Keltner channel is set up at number of average true ranges is 1.5, and it's 20-day, which is the same thing as the Bollinger Band. And the Bollinger Band, and I made a note of this, the Bollinger Band is different in that it measures standard deviation. It measures the number of deviations up and the number of deviations down from the 20 moving average. Okay, and it shows volatility where Keltner shows true range. So whenever the volatility contracts inside, that's where a squeeze develops. And you can see that's where this popped. And it went up to 1.5 average true range. Now what I'm going to do, I will insert this, and I will go to, oh, got to get my glasses on here, Keltner channel. And I'm going to edit this one so that the inputs are 3. This was a question that came up the other day. And that is a target. Okay. Oh, and they're now in blue, the same color as the, let me change the color. Let me change the color to red. Okay. So that now becomes a target. So once that squeeze pops and it goes up and it hits 2 standard deviations of the Bollinger Band, it's going to rest and it comes back off. And then this is where your chart reading skills come in. Once it hits the 20 and it opens above this bar, that's another entry signal. Okay, so you can go right there and buy again. Okay, and once it gets up here to 3 average true range, that's when you need to start moving your stop tighter and get ready to exit. And I would have been gone here, and I would not have taken that blow off right there. Now, I have another secret weapon, and I showed this to Chris a little earlier, and that's, I'll close this down, and I'll close this down, and that's this guy down here on the bottom. Look at how this trades. This is a bottom. This is a retest failure because it failed to take out this bottom. Okay. And this oscillator is a combination of RSI, CCI, rate of change, MACD, stochastics. Anyway, I gave Chris the code for it, and when he has a little extra time, he's in the middle of developing some really super stuff we'll talk about later too. He's gonna develop this indicator for Edge Rater, but you can see there's a little bit of divergence down here, as there is divergence in this price. It came down, it retested this low and failed to take it out, and with the Bollinger Band that got tight in here, volatility had contracted, so the gunpowder is loading, and now it's going to springboard the Russell 2000 up to past 1.5 average true range into 2 standard deviations. It didn't quite make it to 3 average true range. Okay, but as soon as you see a doji candle like this that says, uh-oh, we better be out, this one says you probably should think about leaving because there's a sell-off and you're at 2 standard deviations. The next day they come back and they hit it again and they run it up, and this time it's really out of gas, and it comes back down below the 20. So now you wouldn't do anything until the 8 crosses back above the 20, and it never made it. Even with these candles, the 8 EMA never made it, and it failed again. And so it traveled sideways. The squeeze in the Bollinger Bands came in, volatility came in inside the 1.5 average true range, loaded that powder again, and this time it fired. And when it fired, it it was a short one, but sometimes it's a good one too. So as soon as that the 8 crossed the 20, the 8 stayed above the 20, and the price stayed above the 8. Now you could have been gone here, but you had a perfect opportunity to reload your gun right here at the 20, especially when it opened and went higher than the previous bar and continued on up. But you certainly should be gone when you get to 3 average true ranges. That tells me the party's over. And you can see that once it starts back down here, you can actually buy some puts on the market. And just for grins, let's see what date that was. That was on the 9th of, and I think I bought puts. I'd have to go back and look. I know I bought them when the S&P hit 4,700. I bought 46. I bought 4,600, 4610 puts, and I'll show you a screenshot of that in a minute. But anyway, that's the trigger points for me. Okay, and you can see what happened. This oscillator said, you better be getting out of here, because it peaked out at 107 for 3 days. Okay, and it's at 3 average true ranges above its norm. So I'm going to take this and move it back up. Come on, get a hold of me. There it is. Okay. Did that help? Or did it ask more questions?
No, I think that was good for sure. Let's see if there's a couple more in the question box. I just wanted to.
I could actually put that. I could put Netflix on that screen too. Let me see here, because that's actually the screen I trade off of. And let's see what it does. Okay. And
yeah,
we were looking.
We can't see that.
I'm bringing it down.
Okay.
We were looking for 73 points too, right?
Yeah.
Okay. I'm going to leave it right there. Okay. So we're in here and we're looking for 73 points. So what we're looking for is, right here, we're going to trigger an event at, let's take it above this. This is what I would watch. Okay, so let's say price was 642 and it went on up to, I'm out here, that's 689. So there's 50 points. Okay, 47 points. Okay, so 47 points on that trade, and their expected move is 73 over 30 days, and that was just a couple of weeks.
What were the dates on that, Dave? I just want to check on. If you give me the dates, I'll run my my new tool on that and tell you what the options we're doing.
Okay, so we would have been we would have been 1021.
10.
Actually, we would have been 929 would have been the first signal. Okay. And the second signal would have been right here at 639. Yeah, 639.
929 and 1019, right?
Yeah. And then this one here was 689, 691.
Yeah, that was the price. So I'm just going to run, I'll just do a quick tool on here, see what the options were doing over that period.
Okay.
I'm going to measure from 929.
Okay.
Up to, where should I go to? I'll go to here. And yeah, so we can see like an options, and I could show my screen. I'll show it later, but you can see it. I can see
you can
now.
show it. Go ahead and show it now. Show a tease.
Okay. Let's do this.
And tell me if my 50 delta would have been good.
All right. Well, let's,
because I would have taken a 50 or a 60 delta at that point.
Okay. Find out where my screen is for sharing my screen. There it is. Share screen.
I guess I got to stop sharing, right?
Well, you don't have to. I think it will just let me do it. So
okay, go for it.
Here we go. Okay. All right. Let me know if you can see this.
I can see it.
Okay. If you can see it, then I think it's good. Okay. So in this new tool, what you can do is you can do something like draw a line from the bar that you are considering purchasing the option or would have considered purchasing the option, and you can run it through to the date that you would consider selling. And I might say here, just for fun. And then on the left, you can see that this actually updates with real values of where the various option prices would have been in terms of their percentage gain from start to finish. Going from -1 delta or negative 0.9 delta all the way through to plus 0.9 deltas for the various days to expiration. So, so you get quite a lot of information in this one view.
Yes. Look at that.
And the highest possible gain you could have had would have been a 37-day to expiration at a 0.3 delta. It would have given you a 225% ish gain.
Okay.
Something like that. Yeah.
That's a 30 delta, and it falls within my trading parameters of 21 to 45 days, because that's 37 days, you said?
Yep, yeah. 37, yep.
Okay. And 51 days would have been next, and then 79 days from there. Wow. Yep. That's amazing.
Yeah.
I'm loving that. Now, can you dial in the parameters that you want so you can see what in this case a 37 delta would have done? And I would have taken a 40 or a 50, but I probably would have gone the cheaper route and gotten a 50, which is at the money.
Yeah. So the 50s are down. You see in the chart below.
Oh, I see. Okay.
Yeah. So you got your negative 0.5 and you got your plus 0.5 down here, this row. Yeah. So these are all your 50 deltas.
Okay.
So 199, 200% for a 37-day to expiration, which matches up with this chart up here. If you look at the 0.5 level.
Oh, there you go. Yeah.
Yeah, that matches there. And as you go out in terms of your days to expiration, then the percentage returns are getting less and less.
Mm-hmm.
So, when you go out to 842 days to a leap, you're still getting 43%, 44% return.
Mm-hmm.
But, it's less risky and you're not being paid as much for that, for taking that.
Right. Okay. So I guess what we need to do too is we need to construct a zero cost synthetic or a back ratio spread,
mm-hmm.
and see how that would work too. Okay. That's cool, Chris. I like that.
Well, I've been trying to get this out, and we're getting very close now. So I'm really excited about it.
I'm excited. I am very excited. I'm also excited. Mm-hmm. I just got, I'm gonna look at it. I just got, did somebody hear my Uga horn in the background?
No.
I got an alert that the QQQ turned up at the 8 EMA. And I see the 8 EMA is laying on the 20 today. And so price must have briefly, and it's a squeeze, popped up.
In the Qs.
Mm-hmm. It has to be an intraday.
Yeah. So what we can do, I can enable intraday on here. Now the intraday feature in EdgeRater is basically hooked into Thinkorswim, and what that should allow you to do is, if you're looking at any chart, instead of showing just this current bar, which is Monday, it's actually showing you now a live update of today's date. So if I go back to QQQ, let's see what happened here. This next bar should start coming in. So it's figured out. Yeah. So, okay. So it came down to 39170, 39180-ish. Is that correct?
Uh-huh.
It must be about correct.
That's correct. You see a long carrot on the bottom, or a long candle tail.
Mm-hmm. Yeah.
A lizard tail, and a long wick on the top. That's exactly what I'm showing right at that 20.
And that's at the 20. So the chart layout, what we should probably, this is on your chart layout, right? So if we did that on the, well, what I can do is run, and I'll show everybody where your template is, because that's an important thing. if you look in hot topics and you go down to the DMMA cross with upcoming probability, you can run that. I'm running it on the CBOE weeklies, but the advantage of running the template and having the report is when I click on any of the rows, then you get the signal, you get the indicators that have been configured for the template. So I don't have to go and add those indicators on manually. They're all transferred over from the template.
Which is something I like very much.
Yeah. And so now if we look at the cues with your indicators on, we've got the green line, which is, so there's an 8 and a 20. So the 8 is red, 20 has got to be green, 50 has got to be the magenta, and the 200 is the cyan. And so yeah, you've got this.
Every chart I own, the 8 is red, the 20 is yellow, the 50 is cyan, and the magenta is the 200. But I can't change the colors on your charts.
Oh, well, yeah, it can be changed, but
I just got to edit the script. No.
Well, but however,
that's okay.
I should have added, seeing as this is your chart, I should have added the colors in the way that you want them.
No, it's okay. This is fine.
I didn't realize you wanted the yellow. The only one that's off then is the green one, right? With it should be a yellow. Is that correct?
That should be yellow.
Yeah.
And then the other two are fine. They just reside there as eyeball candy, you know.
Yeah. and what you're saying is that in intraday, if you're looking at, what chart were you looking at for that 820? Was that the 5 minute chart or?
No, that the signal came off the daily chart.
Oh, okay.
So it must have momentarily traded, and that was a trade station notice, a notification. So
yeah. Okay, cool.
I had the alert come on from trade station.
Yeah. All right. Now, I'm looking at some questions. So Ralph is saying, will the new tool do multi-leg options? It's not, the tool is exactly what you see here, which is basically just telling you every single expiration that there was between those 2 dates and every single delta between those 2 dates. So it's basically giving you all of the possibilities. So it's single options essentially, and giving you a percent gain or loss between those two. That's what it is right now.
And it's been months of work, by the way.
well, yeah. I mean, months is an understatement, but yeah, we're nearly there.
Good.
Yeah. Have you seen more of the chat questions, Dave?
No, I haven't seen them. For some reason or another, oh, there it is. It got moved from one screen to another, and I lost it behind my.
Yeah.
So that report defaults to the 8 and 20, but I see Dave looks for the 220 crossover. Can you explain that, please? Oh, yes.
Yeah.
I cheated. That's the explanation. The template is very easy. Let me go back to.
I'm sharing my screen, so you'll have to take that.
Oh,
back.
okay.
Yeah.
Okay. Well, whenever you wanted, you want to share mine? Okay.
Yeah.
All right. Boom. All right, and I'm gonna share this one. Okay, and share. There we go.
Easy.
Okay, so I want to go to seasonality.
Are you going to look at the actual settings on the template before you run it, or so if you go back to templates and look at the 220, what was he looking for? 220 instead of 820.
I got to go here.
Yeah.
Okay. In this particular case, I ran. It is normally, as you see, that's the cues barking at me again. It's normally an 8 and 20. Okay. That's the way the template comes box stock, and that's how I run it most of the time. What I do is I look for a 2 and 20 cross, which is just a shortcut. So I don't have to run another template to look at. So let me go back to the templates. I'll run this template and you can actually see that it only takes a few seconds. Okay. This is the report for that. And this you can see is a fresh new one. I haven't sorted it for 70%. Okay. So this is the 8 and the 20 cross. Okay. The one that you actually saw before was a 2 and 20 cross, so that I can sneak up on it early. I can see what's going on. And in this particular case, what I'll do is I'll go back to I'll clear all of these so you can see exactly what I do. It should give me everything. So 7, 8, 9, and 10. Okay. So now I have a 70% chance on these stocks that they're going to move. And this is the average we'll use ring. Okay. And you can see what happens to ring. And I can actually sort from greatest to least on the next 2 months. And there's our Sava again. And one that I would consider, there's Western Digital, Sienna. Sienna looks like it might have held up a little bit. On Semiconductor, Lilly. Lilly's coming to life. But these are the normal 8 and 20 cross stocks, okay, with seasonality. And I'm going to turn on the highlighter here. And there we go. Okay, so for the next 2 months, we're looking for 9%, 9 out of 10 times on AVGO. Well, let's see if MU. Okay. No, that's T-Mobile.
Yeah, I think you did a search for MU and it happened to just find something with MU in the name. So
right. Okay, what I'm going to do is I'm going to change this to NVIDIA because that's my favorite. Do you know if you went and did a used your start date to end date check, you would find that NVIDIA was the biggest mover in the last couple of years, even bigger than Apple or Microsoft.
Okay.
Isn't that cool? Okay. And there you have a chart of NVIDIA. Let's see if it shows up here as, no, it doesn't have a 70% probability. So I'll just take this out and I'll select all. Okay. And I'll hit NVIDIA again and see if it goes and finds it. It's not finding it.
Well, yeah, you'll have to just do a Control F in that spreadsheet and just type NVDA.
I did.
Maybe there's another filter on there. I don't see it though.
I must have another filter on.
You're not filtered on any of the other months, are you? Like on to the right on that spreadsheet?
Nope. I'm going to close the find screen. It's the find box is on a different screen. Okay. There's NVIDIA. Okay. Oh, I know what it is. All these stupid alerts are popping up on cues. There we go. There's NVIDIA. That's a tale for today on NVIDIA too. So it looks like there's some life coming back in the market, but it still shows down 500 points on my other screen.
No, Dave, on this one, just remember, so on the bottom, scroll to the right of the chart, because what you're looking at
I see there
is not the end of it, right? There we go.
Yep, there we go. There's my trigger point. I would have been long on 10:15 Friday, and I probably would have been out. I probably would have been out here when this big tall wick, if I was if I was trading it, and I hadn't been trading it.
On the tall wick. Okay, I'll just tell you over the line here what that would have accounted for in options. Believe it or not, the biggest percentage gain you could have gotten with that would have been a 21-day to expiration option. The 0.1 delta, obviously, because it's a very high risk, high reward delta, would have given you 8,000% gain.
Yeah. Okay. And just for grins, this is how I would calculate my profit. Okay. First, I would say 10:18 or 10:15 was a Friday, and my expected move on NVIDIA would have been 53 points higher. So that was at 210 points. And it actually went to, let's give it 90 points. Yeah, I wouldn't even give it 90 points. Maybe let's give it 80 points. Okay, at a 50 delta, you'd have gotten 40 points out of it on 10 lot. That's only 40 grand. But I don't have time to trade that. I didn't. Honest to God. I mean, there's so many. I mean, my October worksheet is so full of missed opportunities because I wasn't paying attention. I had a couple of trades on, and that was it. I'm not as active as I once was.
Yeah.
Sorry. I showed Chris a picture earlier. I had my video camera on, and I have 4 boxes of paperwork that are ready to go to my accountant for my taxes this year.
Yeah.
4 file boxes.
That's
so that'll kind of give you an idea. And I don't trade a lot anymore. So anyway, any other questions? The great session. Sorry, have to go. Thanks, Chris.
There's a question. Yeah, a couple of questions we missed in the question and answer panel. Okay. And so one is came on quite early. Was Ed is asking says he notices you use Vector Vest 7. Do you use it in combination with Edge Rater or separately?
Separately. I mean, I have been a subscriber to Vector Vest since 1998. And yeah. I use it every day. Yeah. I use Edge Rater every day. I don't use it for trading much anymore, but it has got so much information. I shared a screen with Chris a couple of weeks ago of my personal timing method, and that's done inside Vector Vest. Is there other people on today that use Vector Vest? Just use that same 8 EMA crossover on the MTI and the BSR. And if you know what that is, then you can put it on there, and you'll see when the market bottoms and when the market tops. And I'm looking at a chart of Dr. Toledo's MTI on a mini graph on the home page right now. And there was a double bottom that actually happened the first few days in October. and you can see the top happen at 160, 150 something. That happened first week in November. So I use the 8 and 20 and the 2050 as my primary trend indicating tools. And there's so many things that are out there. Chris showed you one the other day, Hindenburg, and it fired 4 times this last week. If you weren't protected or hedged for this downturn, you should have been. And I'll tell you right now, I'm still sharing a screen, right?
You are, yeah.
Okay,
I can see your Edge Raider screen.
Okay, well, right now you should be able to see on Option Trader Pro. This is nothing more than a risk graph of 5 puts, and I may or may not have put all the zeros in on the number there. Okay, but this will show you that there's $243 worth of puts have generated $19,750 worth of profit.
Wow.
You got to protect your portfolios. Doesn't matter what tools you use to buy stuff or sell stuff. What goes up must come down, and it comes down twice as fast and twice as hard. Look at Ford. Ford finally broke out. Okay, broke out down here. Oops. There you go. Had a triple bottom. Boom, boom, boom. All of them were at $12.50 a share, $12.40 a share. And it finally decided, okay, I'm going to show somebody something. And you guys go look at the earnings date. Somebody knew something. Somebody knew something.
Yeah, that would be, while you have that chart up, I'll just answer another question that there was a question about the EM bands. You're looking at expected move bands on this chart,
right?
Are they set at 30 days? They are by default set for 30 days, but you can change them to any of the periods. There are 12 implied volatility periods in Edge Raider. You can set them to any of those 12 to see those bands, but by default, and when you click on this report, they will show you 30-day expected move bands. Yeah, so you can see it in there. You've got EM bands 30.
There's 30 right there.
Yeah, and one of the other ones you could use maybe would be the 45. If you change that to 45, that would show you a 45. And then there you go. So now that's covering, and it's shifted as well. So what it's showing you, it's been so it's projecting forwards essentially. So you can see whenever price ends up inside the expected move bands.
Right. There you go.
Yeah. Exactly. Okay, good one. Let's see, what else do we have? Jim McKillop. I think you may have met Jim, Dave, at one of the
the name sounds familiar.
Yeah, one of the sessions down in California. He is asking, what happens to the percent results when there's not 7, whereas when you don't have 7+ years of history in your seasonality, and you're looking for 7, 8, 9, and 10, obviously, so then you're not going to get, if you've only got 5 years of history for a particular stock, you're not going to have 7, 8, 9, 10.
The only reason I do that is so that I have 10 years of history to look at, and I know that I have a 70% statistical probability that it's going to move that percentage. Okay. And there's NVIDIA. Where did I find Ford? I could go look for it, but let me just put NVIDIA back up. NVIDIA was the January one, right? Okay.
Yeah. Yes.
Let me go to Control F here.
Oh no, Netflix was the January one, right?
Yeah, Netflix was January one. And I have a 45-day cone now. There we go. Oops. But I'm not on the expected move. NVIDIA. Now it changes screens. Yeah. So there's what we can look forward to for the next 45 days.
Well, no, and I should say, and this sometimes gets you. It's when you click on in your chart, you have it linked to the layout. So as soon as you change the stock, it's going to actually reapply the current settings for the chart. So even though we did change it to 45, because you clicked on another stock, right, it's gone back to 30 again.
Oh, okay.
If you didn't want to have that, yeah, you'd click off that link to template layout, and it wouldn't change your indicators. Right. Yeah, exactly.
Exactly. Right. Yeah, but I like to look at the different indicators as I go through each one of them. The next signal would be the squeeze, and let me see if I can find NVIDIA in the squeeze. Come on, Control F, give me.
Now that this one, Dave, yeah, this is an interesting one because it's filtered. Look at the squeeze column; it's actually filtered down to things that currently have a squeeze. You can turn.
Oh, that's right.
Yeah, that's the big difference with squeeze. It's kind of pre-filtered, but you can choose all of them.
Right.
And now you can search for NVIDIA or go click it in another template, but searching for it's probably best.
I just did. I still get the chart.
Yeah.
I'll go back to expected move, double click. There we go. Got it. Yeah. Okay. The difference too is it doesn't give me the PSAR and all of that, but that's okay. Doesn't give me the
now, yeah, if you click on the row that's not currently clicked, so say click on NVIDIA in one of the other cells in that row, it will update the chart. There you go.
Oh, there we go. Yeah, exactly. Okay, and you can see this template has got a lot of juice built into it. The stop and reverse part of this means that these dots, as soon as price crosses above these dots, that is your buy signal. And as soon as it comes back down and crosses below these signals down here, that's your sell signal. Okay.
Mm-hmm. Let's see, Stuart's asking a question here. Let me just answer that. Is the report change also to 45 days when EM chart is modified? No, it's not linked that way. So if you change a chart, you're just changing the chart on its own. Mm-hmm. And that's it. If you want to change the report to 45-day expected move, I don't believe that's a setting on the report. I think you would have to probably construct a new template for that. Let's see about that.
No.
Expected move. Oh, here we go. Yeah. If you go back over to templates and in the expected move chart, expected move template, that'll be your second one down from that list. Back in the templates, Dave.
Yeah. Oh, yeah. I'm sorry. I was brain dead there for a minute. Yeah, I can change that to 45. Yeah,
you could change it to 45. And then everything would be linked then to 45. And then when you click on any of the rows, the charts would all be 45, set to 45s.
Right. I'd run that again.
Yeah, exactly.
Yeah. and running it for 45 days is not a bad option when you're not a bad option, no pun intended. Is a good idea. Sometimes when you want to look out farther than 30 days,
Yeah.
There's another good one to.
Yeah, what's happened here, Dave, is you've actually detached your report from your review. So what? Yeah, so you have to probably go and reattach it. But
I'm
let's
going
just
to
see
float it.
Yeah,
separately. There you go.
go.
Okay.
All right. Now, does anybody else have any questions?
Oh, I did it again. How did I do that?
For Dave? Once it's detached, the reports will. This is an interesting point actually for everybody. When you run a report, it will. If your last report you've detached, then the next one you run will be detached. So you should probably close that one down, and then rerun it, and that will probably solve that issue. Or just try and attach it to the reports tab.
Actually, let's see what we get here. I want to run it again.
Yeah.
And then I will reattach it. I know how to do that.
Okay.
That's easy. Okay, so I go to Reports tab.
Yeah.
And now I can just grab this thing, and I'll just jam it in right here.
Yeah, grab it from the top one. There you go. That's it.
Yep, there we go. Okay.
Yeah. Now, whenever you run it, it will be attached.
Right. Okay. By the way, I have a portfolio report. Somebody asked about VectorVest. I have a portfolio report of holdings that I had when I had an account at Dean Witter. In 1998, I was asked to leave Dean Witter because I wasn't producing enough revenue for the broker. You believe in it? So I took it over to took my portfolio to Fidelity. And at that time, I started a portfolio tracker program. My longest running, least profitable return on investment. And originally it was all of these holdings were $3,000, $3,040 to $50, something like that. Walmart was the worst producer. Can you believe that?
Well, but that was a pretty good one, wasn't it? It's the worst, but the worst of a. Yeah, I mean, the others were. You're saying that the others outperformed even Walmart.
Yes.
Yeah.
Yeah. Oh, Governor Abbott is calling. Did you hear the phone ring?
Yeah.
Yeah, that was Governor Abbott. Sorry for the interruption, folks. It's not important. Okay. So,
all right.
Yeah, let me read this. I'm going to sort this by gain. My cost basis on Apple is now 17 cents. Walmart.
You know, we can't see your screen, Dave. Is that
I know. I don't want you to see it.
No, I'm sure.
This was February 6th of 98. My cost basis on Walmart was $21.60, and it's up 552%. Okay. And Apple is up 99,188%.
Wow.
That's my top performer.
Wow.
there's another one in here that just blew me. Oh, Monster Beverage outperformed Apple. Yes,
Really?
it did. Yep. My cost, and this doesn't include options that I sold against them. So it's important to remember, gentlemen and ladies, that your long-term holdings be protected and not worry about their value if you're hedging your portfolio. Okay? Because Monster Beverage at 4 cents a share, now trading at 85 cents a share, is up 242,500%.
Wow.
And my original investment was $3,055. It's important to track those things. But if you never take them out of your IRA, they can't tax you on it either.
Yeah.
But it does play havoc with your with your RMDs. Just ask Jeff. Jeff, are you still on? Anyway.
Yeah.
One question for audio, Chris. Okay.
Oh, great, Ian. Yeah, let me
Ian.
just open Ian's. Let's see, Ian. There we go. You're on, Ian. I think. Or
yeah, can you hear me now?
Yeah.
Dave, a superb masterclass, and the question is going to relate to comparing implied volatility, which will be high for a lot of tech stocks, and the sort of actual true range, or the seasonal move. Am I right in thinking or summarizing that actually you take a greater care at looking at the seasonal move and not as much on the implied volatility? What I mean to say, and this is the question, is that at any level you could have the implied volatility just looking at the supply and demand of options short term, whereas you're looking at the persistence of trend over many days or weeks, and therefore there is a misalignment. But in today's masterclass, you're not really trying to get the nuance of, oh, the implied volatility is up at or is down at sort of 20 or 30%, but actually through seasonals we think that volatility is mispriced and the move could be much larger than that, therefore you get a double whammy.
That's a lot of times what happens is we get a down move. And if I'm still sharing my screen, I believe, if you look at Marathon Digital Holdings.
Yes.
Okay. It went up outside the expected move. Well, and you can see, if you look at the bottom of the chart, that the implied volatility shot way up too. And you can see implied volatility was affected all the way down. So if you're going to buy an option here, you run the risk of paying too much money for that option. And in this case, I'd be a seller. Now let me, someone asked me about how do I, oops, I see what I'm doing. I've got another screen open here, and what I'm trying to do is bring it over into the mix, and I'll show you what I did. I got a question, and at the beginning of the class today, I left my email on the screen for a while, and I'll show it again. Oh, I actually sold Amazon when the volatility was up. And what I did, I don't have it here. I'm sorry. What I did was I sold a spread. Amazon was at whatever it was, 3,500 bucks. It went up to 35.70 or something. And I sold some puts way down below. Let me see if I can get a Control F. And let me get Amazon. What I did was somebody had asked me, they had remembered my email from previous classes years ago. Amazon was up in here, and we talked last week. And so what I did was they wanted to know how they could make money off of Amazon when their options are, a couple $100 a piece if I'm talking about at the money. Well, you don't. What you do is you sell a spread. And in this particular case, what I did was I went down here to in this range in here, and I sold like a 33.80 and bought the 33.60. So I had a $20,000 exposure on a 10 contract spread, and the danger of the market coming off. And that's okay, because I look at, standard deviation and all of that. Let me do an AMZN and bring it up. And I got to move this out of the way. Okay. I don't remember what I did exactly. I'll grab this and move it down here. Okay, and I'm still sharing my screen. So this is yesterday. So Friday, Thursday, Wednesday, Tuesday, Monday. Okay, I think we had our class in here, and the question was, how do you buy options if you're expecting a move like we were getting an expected move last week, and with volatility as high and the cost of the option so high. So all I did was go out in the option chain, and I went out 2 standard deviations, I think. Let me see if we can construct one right now. Let me do the option chain, and I'm going to do AMZN. I hope this is not just a long-winded way. I'm going to float this window so I can move it over here. Okay. Can you all see that? Now I'm going to go to, okay, I got December and January, and I'll even put in a December 31st, because that'll give me, I think, 30 something days. And I'll go to numbers. I want to, I'll change that in a minute. I want all strikes. Okay, so now I'm going to go to, it's trading at 35.10 today, and I think what I constructed was a 33.30. So I sold the 33.30. Yeah. Okay, I want to clear this. Sold a 33.30 and bought a 33.20. Yeah, it was about a $2,000 spread. And there's a risk graph. And there we go. It's loading up. And oops, I'll float that one too so I can bring it over here. Okay. Now, we do a 10 lot spread, and now it makes sense for someone to trade, because you've only got $8,000 worth of risk. Okay, let me make this bigger. Can you see that?
Yes.
You've got $8,000 worth of risk, and our standard deviation is out here at 3277. That's one standard deviation. If I wanted to stretch that out, I could actually put it out to 2 standard deviations and go to 3,000. We could go at 3,050. So let's do that just for grins. Let's sell the, don't know whether we're going to get any money out of it, but let's see. 3,000. Oops. $3,050. Okay. And then I'm going to buy a, oops, same one, December 17th. Only I want the, in this case, I want the 3,030. Okay. Because I want to keep my risk down. I want to limit my risk. I don't want to have all of that.
I think it should be about just 5 minutes now.
Is that giving you what you're looking for?
Yeah, the sort of I sort of withdrew a question earlier on, just in terms of the modus operandi, because I would have flipped this around the other way. That the secret oscillator shows very good entry points when on the bottom of the band, when stocks are selling off, implied volatility is spiking way up, but your statistical method shows actually the seasonals. So when your granddaughter was buying Sava, I'm sure your oscillator would have even anticipated the 820 cross. And I was just trying to sort of, in my own mind, see that I was getting the method that actually it doesn't really matter what implied volatility is doing. It's actually the statistical move that is the secret sauce of the method, as it were.
Basically, because here's my thought on buying versus selling. I sell way more options, probably 10 to 1 options over the ones I buy. I'm very selective about what I buy. And if there's a way for me to sell an option, right now is a perfect time, because volatility is up.
Yeah.
And so time value versus extrinsic value versus intrinsic value is through the roof. So it's best to let the theta get gobbled up and trade intrinsic value when you can. And if you can do that by selling all that volatility, I mean, this week is particularly big week for volatility. I don't have my VIX screen open, but I'm sure it's what, 24 plus
27 now.
27. Thank you.
Yeah.
And each of those individual stocks are going to contribute to that. Particularly some of the bigger ones like Amazon and Google and the old Priceline bookings. They're all they're all ripe for selling the volatility, and that's what I watch for, and that's why I would prefer. You can sense the question was posed last seminar. The selling call spreads on something, I think it was Apple we were talking about. And you want to get nailed big time, just try and sell an Apple call. That guy, the traders will take those out in a New York minute because they know that you're going to get hurt and they're going to make money. So when you've got a day like today, and you know that 3 average true range on Amazon is 3,200, and you're selling something below that, you've got a pretty safe bet, particularly when the delta is down around 5. I mean, that's I watched an interview with Karen the Super Trader, and she was selling 5 deltas, and she was selling them naked. And I thought to myself, selling even at 2 standard deviations, that's 95%. There is going to be someday a reckoning. And she got it. And I'm sorry to say, she got it big time. And it's okay for other people to do that. I'm a safety trader. I will trade naked if it makes sense, but I prefer to have my boxer shorts on at least. I want to make sure I'm protected, and that's where it doesn't cost you that much to put on some protection. And if you can't afford the protection, you can't afford to play. She was just getting greedy, and when there's a possibility that the expected move for Amazon is 300, and I'm looking at the screen, is 317 points, which means it's going to go up to 38.78. I would have heartburn for a week if I sold a 4,000 call. And if I protected it, I'd be fine. But many of you don't know, but I suffer from heart failure and AFib, and I'm on my 4th pacemaker. So I'm here to tell you, I don't need any more heartache.
No.
So sell volatility, just protect yourself.
Yeah.
Okay. There is not a catcher in any league, starting with my 10-year-old grandson, that doesn't wear protection. So, and there isn't a house in the country that's owned by somebody who owes a mortgage that isn't protected. And that's all you're doing, is buying mortgage protection. So if I was going to sell a call on Amazon, I'd sell it way the heck out there, and I'd buy something really tight. I'd probably buy a 10 wide call above it, and sell the one below it. That's why I choose to go the other way. I'll do 2 standard deviations generally on a wild thing like Amazon or unless you've got a really defined trend. And I do it every week. I did one yesterday. Let me see if I can, where is that screen? Okay, I'm going to dock that one, and I'm going to dock that one, and now I'm going to minimize this one. And I'm sorry if I'm wasting your time. I don't mean to be. But
no, I mean, this is pure gold, because I think 99% of the options industry is selling, as it were, option methodology without statistical analysis or to technical analysis. So
right.
This is the sweet spot.
Yes, let me see. Yeah, this is the one that I did yesterday. Yes, I do one every week. Okay. Did I do this one yesterday? Yeah, I did. Okay, so I'm down $500 on 10 contracts. Okay. Market is trading at 46.65. Okay. I sold a 43.60, so I was 300 points under it. And I bought below that, I bought protection. Okay. I have a $2,500 profit potential for a week. Okay. Actually, it goes out to December 23rd, but I do one every week, and I'll run it till it's in the ground, or it costs me money. And this one's costing me $450, and you can see it's bouncing up and down.
Yeah.
And I'll take it. That's fine. I just got 2 Ugo urns from my trade station that said that the Qs, and I showed you the chart, the Qs bounced on the 8 moving average. So if the Qs are bouncing, then the S&P is going to go with it. But it's lunchtime in Chicago. They're coming back from lunch, so they're either going to take it up or they're going to take it down. Time of day is whatever they make it to be. But that's why you get the doldrums starting at about noon in Chicago.
And linking it with part one of the webinar a week or two ago, if I remember statistically, you had 3 losses out of 52, and so you've got a sort of 90% win rate. So.
Yeah, that's exactly right. That's that's what I try and do, and yeah. I don't, and I limit those losses too. I limit those losses to 50% of my cost. So, I think I said I had $6,000 worth of losses last year. Does that ring a bell?
Oh yes, you're right. I'm remembering 6 as the 6 losing trades, but no, that makes sense.
Yeah, and generally, I'm looking at these fills, and it's $2,500. Generally, my fills are just short of 2,000. They're usually about $1,970 to $2,000. Well, volatility's up, so I was able to get $25 out of this. So $2,500. And so I'll take my losses at $1,250. And I'll take my profit when it comes. It may or may not come, but for me, it doesn't matter. Cha-ching.
No, but thank you very much for sharing that, Dave. And I have attended some webinars with George Lee on online, and sort of peripherally many years ago was on the HGSI website. So knew of you and Ron Brown and Ian Woodward and David Elliott. They're sort of that style, and I think it's very powerful combined with options. And you just don't see very many of this sort of combination of skills. So that's really, thank you very much.
Oh, you're certainly welcome. I'm glad to have you. Glad I could answer your questions. I don't know how many people are still here.
Well, we have
got 21,
probably 20-ish. Yeah,
Yeah.
21. Well, 21 including us.
Oh, okay.
Yeah.
But yeah, I'm willing to go a little bit longer, as long as there's questions.
Yeah.
But
Let's see if anyone else has a question.
Yeah.
So if you do, just type a question in, or if you want to raise your hand, or if you want the audio, let us know. We can open up the mic for you.
I appreciate the questions because it helps me get better too. And I have to tell you, honestly, I listened to the recording. I watched and listened that we did last time. And I told Chris, I said, geez, I sound like a decrepit old man because my voice sounds terrible. And today it's even worse. So I apologize for that.
Well, that's nonsense. As I said to you
Very
before,
clear.
that's nonsense. Yeah.
Well, I know there's a gazillion ways to trade, and they're represented in, these are all my favorites. There's a gazillion different ways to trade, and you can get comfortable with what works for you. And I found years ago, in fact, that first page that I shared earlier today, this one, for those of you who need to write down my email address, I'll be happy to answer questions. This is a presentation that goes back years, but you can see if I go to this screen, these are the tools. VectorVest, EdgeRater, FinViz have many tools, what to buy, when to sell, seasonal software, probabilities, real-time trading software is VectorVest, TradeStation, Thinkorswim, Active Trader Pro, which is Fidelity, and RT options, real-time option charts, my opportunity worksheet, and that's what this little guy is here, a trade journal, practice and study and paper trade, have patience, develop your own style or methodology of trading, develop a discipline and stick to your plan. But that's, nothing has changed. Nothing has changed for me in 30 years. This is the book that I put together in this format. I talk about my retirement portfolios, income portfolios, options for income, full protection. Know that we should talk about portfolio today, and can think about the average market pullback between 4% and 5%. And if the average is between 4% and 5%, what's 5% of 4,700? Does anybody
So it's over 200.
want to answer? I'm going to pull up a cheat sheet.
235.
Okay. 5% of would put the market down to 44.66. That's 235 points. So how much How much?
Yeah, it's back online.
Can everyone hear me?
Yep, we've got you back now, Dave.
I apologize for that. I have a 1 gig fiber optic line out here in the middle of the country, and
It happens. I wouldn't have been surprised if my internet had gone down, to tell you the truth. But actually, that's what I thought it was when you disappeared.
I'm sorry about that. Anyway, I was talking about hedging. Take the total amount of your portfolio. So if you've got $100,000 portfolio and it's going to go down 5%, you need $5,000 worth of protection. Okay. If you buy an at the money put, it's going to be really expensive, but that's okay. You can buy 1 or 2. And I paid, what did I pay? I paid $48.50. I paid $48.50. So if you had $100,000 portfolio and you expect you're going to lose $5,000, 1 contract will do it. But if you want to make some money on the downturn, take a couple. Okay, that means you got a $10,000 investment, and if we go down 200 points, then you've got that protection. Roger that?
Yeah.
Okay. I see 2 chats. Ian's got that. Okay.
Tom suggests you need a hall pass to use the loo, Dave.
No, I'm good.
Don't use the internet going down as an excuse.
Well, I'll tell you what. You're going to hear my ding dong go off here in about 15 minutes because I gotta take another pill. So I'm all good.
Okay.
For right now. I still have some of my cold coffee left from this morning. Actually, for me, it's 2 in the afternoon.
Yeah, 8 o'clock at night for me.
Yeah. Was I clear enough on hedging? It works the same way. You just figure out your portfolio, how much protection you need. And you can buy a spider put, or you can buy OEX puts, or you can buy S&P puts. If you're expecting a 5% move on $1 million portfolio, that's $50,000. So you need $50,000 worth of protection. Okay. And you would need 10 contracts at 48.60 is what I paid. That gives you $50,000 worth of protection. It costs you $50,000. But if you went down 235 points, you'd get back times 10 is $235,000. So if you can afford to spend 50 grand and you're looking for that 5%, but remember too that let's see what the expected move is on.
Can you share your screen, Dave, or not?
Would you like me to?
Well, it could work.
Okay. Uh, let's see what I get done here. I'm hiding.
We can see your name.
You
That's
can
it.
see my name. Share my screen. There we go. I gotta pick. Can't hide out forever, Dave. Yeah, but poor Lou. Okay, we're on the spiders because I don't have the SPX
Yeah.
on this list. We're looking for a 30-point move. So 10 times that is 300. They're expecting a 300-point move up and a 275-point move down, right?
Mhm.
So if you want to protect your portfolio or a 275-point move down, that's what you got to look at. Okay. And I can tell you my hedge cost was $48,600. And that's just for that's just for the initial. If this thing really gets serious, I'll start adding to it. But that's for December 17th. Okay.
Yep.
So
that hedge is working out today, then, I would imagine.
I showed the picture of it. It's not. Oh yeah, the hedge is working out. Let me see if I can find that. Yeah, the hedge is working fine. I've got just too many screens going here. That's all. Window. Let's go to risk graph SPX. See if that's the one. And go big. Oh yeah.
We can't see what you were excited about, but it sounds like it's good.
Okay, here you go. Now this is not the real trade. This is a trade, but it's not the one I was quoting. The one I was quoting was a better one than that. This is 46.10. Okay, it costs 48.60. Oh, this is the one. Okay, this is the one. Costs 48.60. There's 5 contracts. Ah, that's right. I left off a 0. And it's up $24,500, $600. Okay.
Mm-hmm.
Now I'm gonna have a momentary lapse of judgment here. Okay. Okay. So there's a reason why. Okay. If my portfolio did go down 235 points, I needed that protection.
Yeah.
Okay. So, and I'm sure, Doc, if you're still on, you're probably going to watch the rerun. Yeah, you're going to watch the late movie tonight, aren't you? After the Jack Parr show, Johnny Carson. Yeah, there's another 5-minute cell single on the spiders. For those of you who are keeping track of the dings. Okay. So right now, oops, I didn't open the right screen here. Let me see which where it is. That's the problem. I've just got two too dang many screens open. All right, I'll just change this one too. Yeah. We are still within a buy zone. We're right at the bottom of the Bollinger Band. On the spiders, we're down 770, 780. Oh, blink your eyes, 790. Okay. So anyway.
Yeah.
We got a long ways to go if it's going to go down 27 points. And that's 5.9% is what they're expecting the move to be. Any questions about hedging?
Ian had a question. Couple of questions. Are you hedging at topping areas? And in your case, you hedged based on your vector vest signal?
Yes and no. If you look at the charts of the big boys, the FANG stocks, as it were, they're controlling everything right now. Let me drag this in. And yes, the my signal came from chart reading. Okay. Can you see this screen?
Yeah.
Okay. If I do nothing more than I'm gonna turn off all of these things so that there's no confusion on anything. Okay. All right. And I'll drag this down, close it down. Okay. Look what's going on here with this oscillator. Okay. We have on 1014, we have our up signal because our 8 went through the 20. And, we're inside the Keltner channel on that same day too. So there's a little bit of a squeeze, one day of it. But if you look right here at what's going on with the candles, everything's going along hunky-dory. And then you wind up with this over here. We hit a top and we hit it again. We came down and we came back up and hit it again. This is just pure unadulterated chart reading. Okay. So now if I was to do this, I would go right here, RTF. That's a retest failure. And that's a retest failure of this high. Okay. It actually went up a little bit higher. And I'm telling you, with that candle and that wick sticking up there, that's a bullish engulfing candle. You got to be short. You got to be hedging your market. And that's at 447. So that's 4470 on the S&P. Okay. So, yeah, I'm short.
That was about the time of the Hindenburgs as well, wasn't it?
Yes. And that's a good point. Let me drag this up here. Okay. And I'll go over here to my templates. I didn't run it this morning, but we already had 4 Hindis in a row.
Yeah, we had 4. You'll find the Hindenburg in the HDSI category.
You'll also find it in here, I thought.
Maybe, possibly. Yeah.
No, what did I do with it?
There it is. Yeah.
Yep. Okay. So we'll just, we usually run it against the other symbol list.
Yeah.
So I drag this down here to Hindi. There we go. And we do this. Now it's going to take a couple of minutes because I got to build a couple indexes. But this is really important. I really think you ought to take the time to see each one of these links, because they are very, very important links. McClellan oscillator is very informative. These will tell you about the Hindenburg omen. Oh, there we go. I'm going to check this. As soon as it's done running, it'll open it up. But this will tell you all about it and where it comes from. Investopedia will give you a lot of information too. So EdgeRater has got so much information in it. There is just, how did I do this? You know, without it. Look at all the Hindis. We even got another one.
Yeah, I didn't quite make it yesterday.
Didn't quite make it. We got 3,
Yeah.
but it's still, that's that's 7 in a row for me. I mean, it's close enough for government work. The only thing that blew it out was yesterday's reversal, and anybody could have been tricked by that. But
it's hard. It's hard to get the Hindenburgs on the way down. It really does pick sort of type, because the conditions that are difficult to achieve are the new highs and new lows have both got to be greater than 2.2%. When the market's heading down, like if you look at 1129 in that row, the new highs and new lows condition didn't fire. What you had was you had new lows at 3.96%, but the new highs were only 1.2%. So
right.
Market already heading down at that point.
Mm-hmm. Exactly. And that's where the buy-sell ratio comes in for me, you know. That tells me that all of that stuff's getting whacked out. And if you look at if you're a VectorVest subscriber, just go back and look. I think it triggered a down signal a week ago. You know, 1, 2, 3, 4, 5, 6 days ago. This is the spiders. 6 days ago was your, you better get out of Dodge. Oh, it's got a VTI sell signal. Does anybody know what a VTI is?
No.
Okay. Everybody knows what a spider signal is. There's 2 other ETFs besides spiders, diamonds, and the Russell IWM. The VTI is the entire market, and the VXF is the entire market without the S&P 500 in it. So here you go. Here's the VTI. A few more minutes of education, and then look at here. This is the same day. Okay. That is a classic top. Okay. Everybody's trying here, but then you still have this. I was just checking to see if there was any messages there. And the VXF is the same as the VTI. The difference is it doesn't have the S&P 500 in it. And what has scrambled the markets is all of those big cap techs have been controlling, 10% of that, the weight of those indexes. So the Amazons and the Googles and Apple and Microsoft and you take all the FANGs, but then you got to add in all the tag-alongs like NVIDIA and Netflix, Microsoft, that it isn't in the FANGs, but it's still a big mover within that index. And this did the same thing. The difference here is without the S&P 500, okay, here's your top. Here, let me do that again. Sorry. Here's your top. Okay. And I'm going to cut that off going right. But look at this. I'm going to do that again. Look at this. What's going on with the oscillator? And just so you guys can see, let me go to format analysis technique, and I will open up, let's go format, no, inputs, that's what I want. Okay, it's got RSI, CCI, MACD, stochastics, rate of change, and a couple of others. There's a bunch of them in there. Okay, and it's all combined into one. That's what this is. So this has got your MACD, and it's got your RSI, and it's got your stochastics. And when I had a chance one time to talk to Gerald Apel and George Lane, they both agreed they wouldn't trade MACD without stochastics, and George Lane said I wouldn't trade MACD without stochastics, and Gerald said he wouldn't trade MACD. Yeah, Gerald said he wouldn't trade his MACD without stochastics, and George Lane said he wouldn't trade his stochastics without MACD.
Mm.
So I was sitting at a money show in Las Vegas with those two guys 20 years ago. So that was enough for me. And there's your price crossing the 8, and it says, oh, I don't like this. And then price crossed the 20, and then the 8 crossed the 20. You better get out of Dodge. You better buy your hedges, or you better put stops under something. And it dropped from, at that cross, that was at 196, and this is on the VXF. That was at 196, and now it's down to 183. So that's 13 points. So just buy a put on a VXF. That'll be cheap, but it's, you're going to have enough to cover 4 to 5% of your portfolio. Okay, there was one other one. Let's look at this. Same thing. Now, in this case, I love this. Qs are saying, I want to go higher. And look what the oscillator's doing. It's saying, no, you ain't going anywhere now. Oh, I got it clear up here. That's the problem with that. I took it up too far. Got to start it down here. And then you can get your divergence in there, see? Oscillators going down, prices going up. Better get out of Dodge. And that's the cues. Okay. Any other questions? Hindenburg. I mean, and that's, let's see, that top was, let's see here.
If you want to see that on a chart, Dave, the way to do it would be scroll your report over to the very right-hand side.
There we go.
And then click in the SPY column, and that will bring up the SPY chart for whatever dates you click on.
Okay, there we go. This is it. There's your top. Okay, and that's on 11/22. That was a week ago. And here we are still wondering why we're not short, or why we're not hedged. 448 was the moving average then. That's clear down here. So that's the first stop. And the next stop will be down here at 429.
Mm-hmm.
Yeah, 426. Okay. So you'll meet some resistance in here. Everybody will give it a big grunt and try and lift the market at the 50. But, and you can see volatility's fallen off. It fell off yesterday. But when we run our thing tonight, we'll see the volatility's back up there again.
And SPY is down right now at 456.63.
Yeah.
So 452.
452.
To 456. That's only another 4 points.
Well, I'll tell you what, if we don't get a rally at 2:30 my time, that's time of day, that's 3:30 Chicago time. If we don't get a rally, everybody's given up, they're going home early, and they're going to let the market do what it does. And we still have to take out that low from 2 days ago. The only thing we got going for us is right now it's hanging at the 20, just below the 20-day moving average, and it's going to hit that. It's going to hit that 50 before anything happens. So, where do I get my timing from? I read the charts every day. I try and get everything done. My market hours start at 8:30. I'm in here with my coffee at 8 o'clock, and I'm generally out of here by 9:30 or 10, unless I've got other things to do.
Maybe now tweet for yourself.
No, I didn't have my tweet.
Okay.
Ian, your mic is still open. You know.
Oh, sorry.
That's
yes.
okay.
Oh, sorry, I didn't know that.
Oh, you can still talk. We'll let you. Is anybody else left? I think there was a few left.
Yeah, there's a few here.
Still got 20.
That's a great oscillator, by the way, Dave. That's a great combination oscillator. I've recently discovered the Z-score oscillator, which is a nice sort of statistical deviation thing. But I think yours is trumps it.
Well, I'll look up the Z-score. I haven't been paying much attention to other oscillators. I do run the MACD report on that might be kind of fun to do. I do run the MACD report from time to time, and I generally run it on daily and weekly.
In part one webinar, I saw that you changed the settings from the classic settings. You had 120. Oh no, that's probably because of the weekly. I think you had a 120 period.
On which one? On the MACD?
Yes, well, you were showing a chart that seemed to have sort of longer term settings.
Oh, okay. That could very well be. Let's just take a look at a signal here. Let me do a SPY. It's not giving it to me. Well, I'll just double click here, and that should give me a.
Yeah, if you click in the, instead of clicking on the symbol, click in somewhere else. There you go.
There we go. Okay, now I'm going to hit SPY. See if it finds it. No. No, my Control F isn't finding S&P. But you can just run down through this list and you can see how accurate. There's a double bottom for all the good it's doing, right? Coca-Cola. Oh, that's European. There's your double top with MACD, price divergence. Anybody for golf?
Mm-hmm.
Geez, I wonder if there's any reason why the market turned over. Look at all these MACD. Double bottom signals is what I was looking for. Yeah. Okay. If I'd have done that with MACD weekly bottom, how about daily top? This, if you've got a good internet connection, it does not take long to grab the data. Okay, and here you go. Here's a double top and the cross is below. There's one from the old days. And now I just, oops, let me take that one back up. ERF. Here's, oops, ERF. Here's one that my granddaughter put in her portfolio too. And it woke me up to one that I used to own for options. I owned it for the dividend and I wrote options against it all the time. Until it was optioned into the ground. I think it owed me money for my price paid. I don't own it anymore, but there was a point in time where, there's a point now, looking at my portfolio tracking report that Apple owes me money. I keep buying their damn phones and 17 cents a share, but I've sold so many options against Apple. It's unbelievable. Okay. Yes, I ought to have stock in Guess just because of my grandkids, H&R Block was a good one for options for a long time. Oh, there you go. Marathon Oil. It turned over with XLE. A guy that is a friend of mine that told me, no, XLE isn't on this one. Thanked me for so much money he made on XLK. And he doesn't even know how to trade options. Said, what do I do with, he made it on XLK. He said, what do I do with my XLE? And I said, well, what's been happening to it? And he said, well, it's kind of going down. And I said, so what are you supposed to do when it goes down? Now, just to put everything in perspective, I've been friends with him since 1989, and he never listened to me, never. And he just started listening about 5 years ago.
Mm.
Toll Brothers. There's a rat in the woodpile. So go look at all the home builders, everybody. Put that on your list. Commercial metals. Wow. Okay. California Water Service Holdings. Let me tell you about the situation with water in California. If you don't know, you can't get it. They've got too many web footers out there. Do I have any California folks here? Understand that I'm a fourth generation. My great grandfather was born in it starts with an S. I forgot. My grandfather was in Santa Barbara, and then my father was born in Santa Barbara. I moved back here, and that was my first time in 1989. There's another water company. I'd own American Water before California Water. Perkin-Elmer. I used to test oil when I was in the Air Force. I'd take the engine oil and run it through a Perkin-Elmer machine, and it would tell me the metal particles that were in it, and I had to change the bulb every time I was changing from copper to aluminum and things like that. Domino's Pizza will always do well.
Mm-hmm.
And this is a great one for doing a back ratio spread. Okay, Gabelli. I will never sell my Gabelli. You know why? I bet you're waiting. I've owned it since $4 a share. And so the $4 a share pays me 15% a year. They pay a 60-cent dividend. So if I took my $4, and I think it's $3.94. So let's take 60 divided by 3.94. Yeah, it's 15%. It pays me a 15% dividend to occupy space in my portfolio. Okay. Those are the kinds of things that you got to buy. So the next time you get a crash, like now, wait for it to go down. The pandemic, let's take this back to, there's March. Yeah, it was $5.75 back here. So if it pays 60 cents a share on $5.75, figure that one out. But it actually got lower than that. Okay. When the pandemic hit, let's see, that's 2020 October. You got to go back to February. Yep, there you go. January of 2020. Okay. That's the last time there was a big buying opportunity for it. So I loaded up some more. And there you go. It was $2.80. So my average price now is $3.94. And it pays, if you look at the history of the dividend, it didn't matter what the market did. It paid 60 cents all the way back. I mean, there was some times it was up and down a little bit in the early days, but it's been paying a dividend since before 1990. because it is a closed-end fund. Okay, this is another good one. I don't know where the chart went. There it is. Okay. Long-term holdings on this one.
When you're ready, Greg has a question for you.
Yes.
Yep.
Speak
His question
up.
is, well, I could put him on if he has the mic open, or maybe I'll
Okay.
just read your question. Let's see.
Okay. Either way.
His question is, would you be buying today's dip?
No. Nope. Not yet.
So he hasn't got a mic. Okay.
Okay. The answer to that question is no. Because here is, once again, this is going to be a chart reading skill. This is a top. It's a double top, retest of this old top, failure with divergence. And this is on the Qs. Okay. This oscillator is telling me that we probably have more to go. And you can see that this old low took this down to wait a minute. It took it down to, where's my, well, it's down below 10, so it's probably a 6. Okay. Oh, there it is, 8. The DMAC indicator is at 8. Okay. And that wasn't even the low. So what you have to do is wait till this firms up. The 44 is a good baseline. And you can see here, there was a sell-off at 44, and it went down to 44. And then here it is again. But this time, the oscillator went lower, but the price was higher than the previous low. Okay. So that's why this ran up, hit the wall up here, and retested it a few times before it came back down again. Okay. And when it came down, it came all the way down. And you can see it had to rest on the 8 that it hit. The oscillator had to rest, but the price kept going down and the oscillator rebounded. And that's part of rate of change and RSI getting its act together inside that oscillator. And you don't have that. So just use the chart. Okay. Here is a bottom. It's lower than this bottom, but it's right about the same bottom as this one right here. Okay. So that one's been tested. There's your reversal bar with a long wick on the candle, and it's an inside bar. And I say, I ain't going yet. So you wait till the next day. That day says, and I'm not even looking at the oscillator down below. Okay. That day says, okay, I've closed higher than the previous day, and I've closed higher than the day previous to that, but I haven't closed bigger than the 3 days before. Okay. So the next bar, you count back three days, and this one says, yes, I opened higher and closed higher, but I'm a doji. Nobody's trusting this candle. So the next day, you get another bearish engulfing. And guess what happens? You wind up with a long wick sell-off back into the body of this buying. And then you have another bearish engulfing, because it engulfed the high here and the low. Didn't go above the wick, but it's still a bearish candle. And then you got some buying, and it comes in higher. This is higher than these bars over here. So now you have a new higher low from this one. And the next day, your candle says, okay, market says it's time to go up. We're tired of going down. And we've sold out. So we're going to go long. Okay. The candle closed above the 20, and that caused the 8 to cross above the 20. So on this day, it's okay to take a position, a small position, because you never know. You see this candle? It just barely took out the high of this big long wick. Okay. And I'm trying to make this as simple as possible so everybody can understand how important chart reading is. On 10:15, I actually initiated a few positions on 10:14. On 10:15, it was a clear cut go. That's on the cues. Okay. And you can see that it took off. Now, ordinarily, I would have been happier if I'd have seen these Bollinger Bands come down inside the Keltner, and the same thing with this one. This Bollinger Band come up inside the Keltner, because then that would have sold me on this is an honest to gosh good rally. Now it happened back here, but it was failing. So it had to recoup and reload that shotgun shell, and it never really got off the ground. I mean, it did, but when you get to a point like this where the Bollinger Bands squeeze inside the Keltner just like that, that says, okay, I've got some room to run. Okay. And it did. And it ran 10 points. I mean, 10%. Yep, it did. It ran up here to 387. So yeah, about 10%. But then it just didn't have enough juice in it to sustain it. What it needed to do was it needed to travel sideways for another few days or a week and let this whole thing settle down. But everybody was so antsy. They were afraid they were going to miss something. And the truth of the matter is, if this down in here had started a month later, if this oscillator had been down here a month later, when this was happening, then these Bollinger Bands would have been inside the Keltner, and that squeeze would have been a big push, and this would have gone along for a lot farther. But it didn't. And so this is where we're at. Read your charts. There's a big bearish engulfing with a wick on top. You got to be gone, and hedged right in here if you haven't done it already. Okay. And when I enter again, you can see right here that the Bollinger Band is now inside the lower one. Is it? Let's see. The lower band is 388 and the lower Keltner is 387. So the Bollinger Band is in here. Give it a few days of sideways motion to get this shell loaded. I mean, because it's got to pack some powder when it blows out this time. We are seasonally, we should be ready to rock and roll, but there's so much uncertainty with the Omicron. It's not Omicron, it's Omicron, and with delivery of Christmas and inflation. They're going to start dinking around with with their bond buybacks and their stimulus, and who knows what's going to happen with Mr. Powell. So the answer to my question is no, not yet. And I don't care. I don't care what signals cross or what oscillators go up and down. It's all supply and demand, and we are still in too much demand, too much supply, and not enough demand.
Yeah.
So I'm still short.
Okay. It looks like a lot of people have been leaving. Dave,
Okay.
I think it might be a good time to wrap it up.
Yeah, I was just giving them more information.
Uh-oh.
And I'm ready to rock and roll any day, anytime. Okay.
Thanks for that. That bar by bar was really useful.
Good. I'm glad to hear that. I'm glad to hear that you stuck around for it too, Ian. It's really easy for me to get long-winded. But as one of the other attendees last time found out, some of it's pretty complicated, and sometimes I go fast, and today I wanted to slow it down to make sure everybody understood. But the most important piece of the puzzle for me is this right here, and it doesn't matter what template you use. There's so much value in all of them. And for $1,000, while it was on sale, I saw that and I went, you got to be kidding. How does this guy that developed this horsepower, I mean, how do you make 10,000 horsepower out of a little tiny 2-stroke motor? And he did it. Thank you for that. I appreciate it.
I appreciate you and everything you've helped with. Absolutely. It's been really, I think it's just, it's amazing listening to you, with all the experience that you have, and you've such a wealth of information. I'm sure everybody here really appreciates it. And I hope we can get back on again at some point soon.
Okay. Just invite me and I'll come. I'll tell you what, I was really glad to see Jeffrey Scott. I didn't get to speak with him, but I certainly would love to.
Yeah.
And
maybe we'll see if we can get him on maybe as well. That would be cool.
That guy is smarter than anybody I know. He really is. And he knows how to take advantage of situations and manage them better than I could ever hope to. He's an awesome man. And I appreciate him, and I appreciate the input that I've gotten from him over the years, and a lot of his trading style has been really good for me too, because I've learned a lot from him.
That's great.
Yeah.
Those were the days when we used to have regular meetings down in California.
Yeah.
Twice a year we'd get to meet up with everybody. It was really, really good.
And I would like to
actually even more when because we would have the HGSI meetings, and also we'd have Greg's meeting down in Santa
Ana.
Santa Ana. Yeah, I was going to say, what's the name of it's Mesa? That's not right, is it? But yeah, Santa Ana. You're right.
Santa Ana.
Yeah. So they were really good.
Yeah.
Anyway.
And I will accept anything anybody has to say in terms of questions or comments, and at any time anyone has it was Orange County.
Yeah.
Yeah, anytime anyone has any question, please send me an email. I'll do the best to answer it. I could post my phone number, but
maybe
I
not.
think I think it'd be great to talk to people, but the problem is I get so many unsolicited calls for everything from Medicare to warrants out for my arrest.
Mhm.
And I got to call them right now because we're sending the sheriff if you don't call right now. And, and here's the number. Give me your credit card and I'll keep you out of jail. You know,
Yeah.
I'm so tired of that robocalls. So if I don't have your name and number in my database or in my phone, then I automatically don't answer. But if you send me your name and your phone number, I'll enter it into my phone, and then I'll know who it is, and I will answer. So
Very good.
thank you,
Okay.
everyone. I really enjoyed myself today, and I've talked for 3 hours. My voice has gotten better, and I've learned a lot. And I hope I've imparted some knowledge for all of you.
Absolutely.
Outstanding. Thank you so much.
You're all welcome. I'm going to stop sharing. I should have done this before. And now, Chris, you could take over your meeting.
No, that's that I appreciate. We only scheduled for an hour and we've gone 3 hours nearly. Is it 3 hours? Yeah, nearly 3 hours. But that's
right.
just because you had a lot to say, and everyone, I appreciated it. I'm sure everyone else did. Yeah. So thanks everyone for showing up. Let's see if we can schedule something else at some point. As Dave said, if I schedule it, he'll show. So that's a good thing.
No problem.
Yeah.
Whatever I don't know if 10 o'clock Pacific time is a good time or not, but
well, does it work for you?
It's a little tougher, but it's fine. You saw whatever I had moved.
Yeah. You got rid of that.
Yeah.
That's good.
Yeah. My wife only came in a couple of times. I got a kiss on the cheek once. So anyway. All right.
Well, very good.
Thanks so much, everyone.
Yeah. And thank you.
Next time I'll turn my camera on too. I wouldn't turn it on a couple months ago because I had a ponytail. Nobody would have recognized me then. I looked like a damn California hippie. Anyway, y'all take care, and I'll sign off.
Thanks, Dave. And thanks, everybody. And I'll close it down. Bye.